Let's bring in Brian Jacobsen. He's a senior investment strategist at Wells Fargo Asset Management to talk about this. Brian, such a bounce back. I mean, a complete reversal, especially of the losses we had seen at the end of the day on Friday. Give us a sense from your perspective of what the factors are for this market activity today.
Well, yeah, I think that it was interesting to compare this episode to actually what happened back in October 1997. Back then, you had a mini crash with the stock market over a very short period of time, big sell-off. A lot of people blame programmatic trading. The Federal Reserve had hiked earlier that year. You had the Asian financial crisis. Earlier that year, too, you had the breakout of the avian flu in Hong Kong. This looks an awful lot like that episode, right, as far as with the coronavirus, and now we actually have a big loss followed by a huge gain, and that's exactly what happened in 1997. Treasury Secretary Rubin came out and said, hey, we're watching things and we'll act as appropriate. Well, Chair Powell on Friday said basically the exact same thing. And after Rubin had spoke in 1997, you had the largest point gain in the Dow in its history to that point, and what do we have today? The largest point gain in the Dow in its history. So, history doesn't repeat, but it certainly seems to rhyme pretty closely here.
And so does Powell have a playbook to go forward with? There was so much talk all throughout the end of 2018 and going into 2019 that his playbook is essentially out the window. Just following Yellen's playbook will no longer sustain itself. Does he have a playbook based on what even prior people that have held his position have had to go through international health scares?
Yeah, I think that they have a playbook, but it's not necessarily like it's a map or a songbook where it spells out exactly what they need to do. It's more of a contingency planning. And the Fed, really, they do take their lead from the financial markets. They watch the same data that all of us do, and they try to process it and make sense of it and come up with their forecast and just act in the most appropriate way possible. So their playbook is really, I think, to take their lead from the market. And the market was expressing initially very little concern about coronavirus. Suddenly, people started panicking a little bit about it. Thankfully, the Fed hasn't panicked about it, but they did take notice, and they are going to act as appropriate. And based on the data, it does seem like the economy could use a little bit of easing, if anything, to just deal with financial conditions. Kaplan out of Texas, he had said about how they really want to watch credit spreads and financial conditions and make sure that they act in a way that's going to support the financial system to make sure that credit doesn't really get constrained too much, so that way they can still encourage economic growth. So they're not going to necessarily act on the basis of what happens to the Dow or the S&P 500. It's more about what's going on with credit spreads and financial conditions, and that's when they're going to step in. And I think they're probably going to do that by March 18th, which is when their next meeting is.
Yeah, and I think you bring up a great point, because last week we talked a lot about this idea that we had just really blown off the extra foam, right, off of our lattes and cappuccinos with the price valuations of these stocks. And so what we're dealing with now, or as of that last week time period, looking at those fundamentals. But to your point, I mean, there still seems to be some trouble then brewing underneath the surface, below the surface here. So what should we be concerned about going forward if today was just another bit of a jubilance after, the big sell-off last week, and maybe we're putting that veil over the problems and not dealing with them properly, and maybe leading to an even steeper decline down the road?
Well, that is a concern, is whether or not sentiment runs ahead of itself, and that's the way that, unfortunately, the financial markets work. They overreact to the upside, they overreact to the downside, and then we kind of bounce around in between. And today we got a nice bounce back, but we're still, we'd have to get back up, I think, 9 to 10% more to get back to the peaks that we were at before. And even at that point, the Fed was talking about how they thought that asset prices were a little bit elevated relative to the fundamentals. And so really, it is an environment where it's still slow growth and it seems tentative. And this morning's report that we got on the ISM manufacturing survey, even though it showed that manufacturing was still in expansion, that was only due to supplier delivery times really increasing. And those weren't increasing because demand was so great. It's because there was actually supply chain disruption. And that's not the type of thing that the Fed likes to see. That's not the type of thing that's conducive to growth. And so that's why I think that we're really going to be watching for those signs as to whether or not the supply chain is really getting unclogged here, because it was really stifled and clogged up as a result of the quarantines, and how quickly can we kind of get back to a more normal pace of economic activity.
With the declines of last week, was there money that you looked to put to work within your own strategy and look for at least a bit of a bounce like we're seeing here today?
Yeah, and thanks for asking about that. On my team, the way that we were positioning portfolios, we were somewhat neutral between equities and with bonds. We thought that equities were maybe a little elevated with their valuation, so we kind of lightened up with our exposure. We were also favoring gold for a good chunk of the year to date so far, which it kind of paid off. So going into it, we didn't feel like we were over our skis in terms of risk exposure, that is exposure to equities or to high yield debt or anything like that. So we did view it as, okay, the sell-off, not that we predicted that the sell-off was going to happen, but we did take it as an opportunity to start repositioning into areas that we did like. And some of those areas continue to be emerging markets on the equity side, because we think valuations are much more reasonable there than what they are, say, in the United States. And then on the fixed income side of things, we still do like high yield debt, but more, as one of our portfolio managers, Margie Patel, would always call it, the creme de la junk, as opposed to really scraping the bottom of the barrel of the junk drawer of the fixed income market.
Yeah, and the treasury yields that we've been watching, I mean, okay, explain this. Equity market's up today, right? 5% if you're the Dow, 4.5% if you're the S&P, 4.6. But then you still have the 30-year, I mean, yields are also still at new lows as well. So what is this, a hedge here, Brian?
Well, I think that is a good way to think about it, is within a portfolio context. A balanced portfolio is going to have exposure to fixed income and to equities. And so there's really nothing unusual about those assets performing well together, where they diversify each other. In fact, what we saw last week, right, the equity market sold off, and we saw the fixed income market, especially that 30-year, really the yields fall. And so if you had a balanced portfolio, it kind of helped offset things a little bit. Now what we saw today, equity market rally, and those yields began to move back up. Not a lot, but it did move up some. And I think that one of the key reasons why they moved up some, but not dramatically, is because the underlying fact is that we still have slow growth, very low inflation, and an accommodative Federal Reserve. And so the slow growth, low inflation, and an accommodative Federal Reserve tends to keep yields suppressed, but it also tends to support equity markets as well.
Okay.
Brian, we got to leave things there. Things are getting super interesting down here, though, nonetheless. Brian Jacobsen, who's the Senior Investment Strategist at Wells Fargo Asset Management, thanks so much for taking the time.
Thanks.
Thank you.